Welcome to a look at the economy and markets with John Rubino. John Rubino has been a longtime friend of mine, and I really do value his insights that he makes public, and they are available to you as well. You need to go to dollarcollapse.com and sign up for John's free missives. But he has been an analyst of the markets for a number of years, and he does a very good job, I believe, of highlighting from a macro perspective what's going on in the economy. You know, I have frequently with me podcasts with Daniel McAdams and David Jensen, and so I'm really hoping that we can get John on a fairly frequent basis on a weekly basis, hopefully, for the most part, to do these podcasts, and we'll call it a look at the economy and markets with John Rubino. John has been on my radio show a number of times, and so most of you probably are familiar with him, but for those of you who may not be, let me just read quickly through his bio. John runs the popular financial website, which I just noted, dollarcollapse.com. He is co-author with Gold Money's James Turk of The Collapse of the Dollar. It's a fantastic book, a very, very important book that was written a number of years ago, but still more timely than ever now. And that was published actually in 2007. He's also the author of a book called Clean Money, Picking Winners in the Green Tech Boom. That was written in 2008. How to Profit from the Coming Real Estate Bust, and that was written in 2003. And if you'd followed his advice, you certainly would have made some money a few years later. And also, he's worked over the years on Wall Street. He's earned a degree in finance, an MBA from the New York University. He spent the 1980s on Wall Street as a Eurodollar trader, an equity analyst, a junk bond analyst, and during the 1990s he was a featured columnist with TheStreet.com and a frequent contributor to Individual Investor, Online Investor, and Consumer Digest, among many other publications, and he currently writes for the CFA magazine. Welcome, John. It's really good to have you with me, and I do hope that we can discuss the economy and the markets on a regular basis with you.
Thanks, Jay. It's good to be here. Great to talk to you again.
Always good to talk to you. You know, on your April 4th missive is what I'd really like to focus on mostly today, and then perhaps touch on one more recently titled More Scary Numbers. But your April 4th missive was titled, Is the Whole World Slowing Down? And just from my own sense of the news, I quickly, in my own mind, answered in the affirmative to that question. From what I've just sort of seen going on in the markets, what I see in the headlines and so forth, also from something that I keep up with called my inflation-deflation index, is indicating that, if anything, all of this quantitative easing and monetary stimulus seems to be running out of gas. At the same time, as you point out, we're building up huge amounts of debt. So, you started out your article, John, the April 4th article, Is the Whole World Slowing? You started it out by asking, or by stating, that the stats just keep getting stranger and stranger. Can you give us an idea of what you meant by that? What's really becoming stranger and stranger with respect to the economic statistics that we're given on a regular basis?
Well, if you look at what we've done in the past 5 years, since the big crisis of 2008, 2009, instead of deleveraging, in other words, paying off some debt because excessive debt's got us in so much trouble before, we actually went the other direction. We borrowed $57 trillion worldwide in the last 5 years. And during the same time, we've cranked up the monetary printing presses. Most of the big countries of the world have dramatically increased their money supply. Like the U.S. has almost doubled its M1 money supply since 2010. And the same is true of most other big countries. So mainstream economic theory says that when you borrow huge amounts of money and you create huge amounts of new currency, you should get a boom, and our biggest problem right now should, in the Keynesian framework, be too many people getting great raises at work and buying stuff and causing inflation to really spike.
Right.
But actually, 5 years into this, the opposite is happening. Japan, for instance, just announced that its factory output is down dramatically year over year. And since Japan is really a manufacturing export economy, factory output's a big deal for them. That means their economy is slowing dramatically from a year ago. And China just came out and announced that its economy was going to undershoot its growth targets fairly dramatically. They didn't give a number, but they used some language that made it sound like it was going to be a big miss. And China, again, they borrowed huge amounts of money, something like $15 trillion, just they themselves, since the 2009 crisis. And that money has been spent, and it's not resulting in dramatic growth. And the U.S., of course, on this last Friday, announced that really the only great part of the U.S. economy over the last couple of years has been jobs. It seems we've been adding lots of new jobs. But on Friday, they announced that we only added half as many jobs as most economists expected in the previous month. And they went back and revised downward the 2 months prior, so that we're not actually adding that many new jobs, and everything else is kind of negative right now. Housing is flat, manufacturing is flatlining, new factory orders are down. So the big economies, most of the big economies, are not growing after this huge debt binge and after all this money printing, and that's very scary, because what do you do then, you know? And interestingly, only Europe is a bright spot right now. They're actually growing a little better than expected, and you know, it's still not great or anything, but compared to the trajectories of the other major economies, they're doing okay. And so what lesson do we derive from Europe's relative success? And that is that devaluing your currency actually does help, because they enacted QE late last year, or at least announced that they were going to enact it. And the euro has been falling ever since. It's down by about a third versus the dollar in the past year. And what that does is it makes European exports cheaper because they're pricing them in euros to start with, which means they get to, in effect, put their stuff on sale by 30% around the world, whereas stuff priced in dollars is now 30% more expensive. Makes it harder for us to export relative to European competition. And it's kind of sort of working. German exports are at record levels, and their economy's growing, and they're kind of pulling along the rest of the Eurozone. And so, drawing on that lesson, you would expect the other big economies to be getting ready to devalue their currencies in the year ahead, because that's the basic currency war script. Somebody devalues their currency and does reasonably well versus their trading partners for a while. But of course, it comes at the expense of their trading partners, who lose business and slow down. And then they have to respond in kind. So the response in kind is coming, and it's going to be the dollar that has to be forced down on international markets, and the yuan, which is kind of sort of pegged to the dollar. So if we devalue the dollar, the Chinese currency will go down too. And the yen has already been somewhat devalued, but needs apparently to be devalued more going forward. So that's the dynamic that we'll see unfold in the year ahead, where the other major trading powers have to devalue their currencies. And of course, this is just a zero-sum game. You know, you can't win in the long run by trading off devaluations. You know, you can only win in a little while for short run, and then your trading partners are going to respond and disadvantage you, and then you'll suffer for a year. You know, it goes back and forth like that until there's a resolution.
Yeah.
And
well, here's the thing, John. As they're doing this, they're creating debt, and debt is growing, as you pointed out. It's growing dramatically, and so the debt remains, but the income isn't there to service the debt. Is that why we're seeing a difference? For example, you know, you said what we should expect to see is wage pressure now. We should start to see a booming economy. Indeed, in the 1970s with monetary stimulus, that's exactly what we saw. But what you're talking about reminds me much more of what I read about in the Great Depression, the beggar thy neighbor phenomenon, where all the countries tried to cheat on their neighbors essentially by doing exactly what you were talking about, by debasing their currency, by printing more money. Yes, we were on a gold standard then, but nobody paid attention to it completely even then. So there was sort of the beggar thy neighbor phenomenon going on, but this would seem to be much larger than anything that happened in the 30s. Do you think that's what's going on? Is it the debt is actually becoming a drag on economic activity, which then is making It's almost like if you were in quicksand, and you try to battle your way out, and the more you struggle, the faster you go down into the quicksand. It seems to me something like that going on. Do you agree?
Yeah, that's one of the really common sense aspects of life that economists don't seem to get for some reason, which is that
Yeah.
if the more money you borrow, the harder life gets, right?
Right.
Whether you're an individual or a family or a country, it works the same way. The money that you would have spent on productive, fun stuff, you have to spend on interest, and that makes your life, the quality of your life, a lot less interesting, as basically anyone defines it.
Right.
If you can spend more money on the stuff you like, the quality of your life is better, and vice versa. And so we're in that boat now where we've borrowed huge amounts of money, and we've been doing it for 30 years, and we're at the point now where the numbers are just insane. If you look at debt to GDP or almost any other big stat like that, you see that we are more deeply indebted than any other society in the history of the human race. So it shouldn't be a surprise that we're paying a price for that. That economic growth is harder and harder to come by, and that to try to combat that problem with more debt is counterintuitive at best and crazy at worst. So we're going to find out if that statement I just made is true in the not too distant future. And I think it is. Yeah.
Well, we see, John, that the debt. I look at this one chart. It shows total debt in the United States alone, and it shows debt is growing almost exponentially, and income is growing at best in a linear fashion, but very slow. And so, it doesn't seem like you'd need a degree in rocket science or to be a neurosurgeon to understand that at some point in time, the system has to break down, given that debt is growing so much more rapidly than income, or something has to give, you would think. So
something has to give, yeah. And that's really the question. How do we get out of this? Because there's no painless way to do it, contrary to what today's policymakers would have us believe. We have to get rid of this debt somehow.
Yeah, indeed. The policymakers want to keep us believing that they have everything under control. But you come out also, as I mentioned, more scary numbers. As a piece you wrote today, corporate profits have been strong. You note there, and they have been, and the market has been reflecting strong corporate profits. But they do seem to be at extreme levels, though. We're reaching levels now, equities and debt and financial values of financial products relative to GDP. Could you talk a little bit about how stretched the equity markets and maybe the debt markets have become relative to GDP, which is really the cash flow that we need to service or to justify equity prices and to service the debt?
Yeah, the list of numbers that are at all-time highs is really growing. It's really becoming immense, and that list is being joined by a list of things that, in terms of GDP, as a percentage of GDP, are also at all-time highs. And corporate profits are one interesting example. The amount of money that companies can make is kind of constrained by nature because in a competitive market, for instance, if companies are making huge amounts of profit, they get huge amounts of competition. More people enter the market, and that drives down profit margins. So you can only make so much before the competition becomes overwhelming and dysfunctional, causes the economy to tank for a little while because so much malinvestment happens when all these new guys come in who don't really know what they're doing and they go out of business eventually, but they have half price sales on the way and drive everybody's profits into the ground. And at the same time, if corporate profits are very high, the other actors in society, like governments and workers, they want their cut. So companies can only make so much before their workers demand much higher pay or governments raise taxes in some way. And we're seeing that around the world, especially in the U.S., though, where we're seeing the movement towards a higher minimum wage and where governments are looking to close offshore tax loopholes because that's one way corporations are hiding all the new money they're making. And that is going to limit corporations' ability to make more money going forward. If you look at a chart of corporate profits as a percent of GDP, you see that we're at an all-time high. It's never been higher than this. And in the past, when corporate profits relative to the economy have spiked, they've only gotten up to that spiky area for just a little while before they came back down hard because of the forces that we just talked about. So unless this is a very, very different world, corporate profits at this level are unsustainable, and they're going to have to come back down. Mm-hmm. Now that's one percentage of GDP number that's very interesting and very scary, but there are others. For instance, as you mentioned, equities market capitalization as a percentage of GDP. In other words, the value of all the stocks in a given country relative to its economy also seems to be constrained. You know, it can get to a certain point, and then that's just too much money in the stock market, and it has to go back down. And it usually goes back down because of a stock market crash. Well, we're at the second highest point ever on that measurement, and the only higher measurement was in 1999 when tech stocks were just through the roof. But we're at a higher level now than we were in 2007 before the huge crash of 2008, 2009. Wow. So that's another scary stat. And then and one further one that comes from Doug Nolan at the Credit Bubble Bulletin is the value of all financial securities. That includes bonds and money market funds, et cetera, of all financial securities as a percentage of GDP. And that is also at an all-time high. It's higher than it was in 1999. It's higher than it was in 2000. And so those previous peaks were followed by dramatic declines in which there was a financial crisis of some sort, and the value of financial instruments went way down relative to real things. Mm-hmm. And so you look at all of these different measures of finance in the economy: corporate profits, equity valuations, financial security valuations relative to the economy. And the only conclusion that you can draw is that either this time really is different in a big way, or we've got some kind of a crisis out there that will bring things back into balance across the board. And I think we're seeing the beginnings of that now, where corporate profits fell in the fourth quarter, and it looks like they're going to fall again in the first quarter. So we'll have 2 consecutive quarters of falling corporate profits at a time when corporate securities, in other words, stocks and bonds, are priced for perfection, priced for continuous growth in corporate profits. Mm-hmm. Yeah. So one of those two things has to change. Either corporate profits have to start soaring again against all historical precedent, or the value of the financial instruments in this society have to come back down. Now, one wild card here is global capital flows. There could be a crisis in the rest of the world, and there are lots of possibilities that send huge amounts of money flowing into the U.S. basically at any price. You know, people are going to buy treasury bonds if they're terrified in China or Europe or whatever. Mm-hmm. They might buy U.S. equities and bonds at any price, and they might pump up the profitability of U.S. corporations by buying our stuff and investing in them. And that might buy us some more time. So it could be that we get even more out of whack because of global capital flows. But history says that we're towards the end of this process, no matter what. You know, there hasn't been a time in the last 100 years when we were this out of whack. Yeah. And so it's a very, very safe bet. But sometime in the next few years, these valuation measures and these profitability measures revert to mean. They go back to their more historically normal levels, and they do that via some kind of financial crisis. Now, the question is, does it happen this year? You know, does the current downtrend in corporate profitability lead to all of these things? Right. Or do other things short-circuit that in the intermediate term and buy us another couple of years? And that's unknowable, but I think it's safe to say that 5 years from now, we're going to look back on this level of valuation and this level of corporate profitability and say it was excessive.
Right. Well, just as we have in 2000 and 2008, 2009. But how soon we forget, John, how soon people forget the lessons of the past, or they conveniently assume that this time it is different. I mean, that's something you hear always when evaluations become frothy. You start to hear people say that. Yes, but this time it is different. You know, this morning the equity market started off looking pretty weak, actually. The futures markets were down quite a bit. Looked like the Dow was down well over 100 points or so. And there was, I guess, on the back of some pretty bad employment numbers that you were talking about earlier, that along with, I guess, people starting to wonder exactly about what you were talking about. Will the profits be there if the economy is remaining so weak? And but of course, all it took really was, a Federal Reserve official from the Federal Reserve Bank of New York coming out and saying, "Yeah, well, I guess maybe we won't be able to start allowing interest rates to rise anytime soon, or if we do, it's going to be further off than we thought. And if it does happen, when it does happen, it's going to be very shallow." So we got a new buzzword now. It's called shallow. Instead of patience, it's shallow is the word that we'll be hearing, no doubt, over and over and over again from the propaganda artist. It's going to be a shallow rise, if anything. And it just seems to me, John, that what they're trying to do is to keep Wall Street happy, keep Wall Street confident, and keep the animal spirits alive. As John Maynard Keynes says, doesn't matter if you're broke, doesn't matter if you can't put food on your table, doesn't matter if your balance sheet is wretched and you're underwater. We'll just print more money. And what I don't understand, what really scares me, is the fact that, as you point out, we've got a very weak economy globally. But if the analysis of the cause of that weakness is wrong, then we're doomed. If the malinvestment that occurs, the capital going into bad places, we continue to see debt growing, but the income doesn't keep up with the debt to service that debt, then you have to believe that this is not going to end well.
Yeah, the Keynesian solution to this, I think, is to overwhelm the bad debt with new money.
Right.
And historically, that hasn't worked too well. You can go back to John Law in France and Rome's hyperinflation. There have been a lot of attempts to flood an economy with new, less valuable money in the hopes of getting it moving again after a period of taking on too much debt. And there's no example, as far as I know, of it working. And we're doing it on a global scale now. We're doing it not country by country, but everybody out there is being pulled along into this. Even Switzerland or someplace like that really wants to run a sound currency regime has no choice. They get sucked into the currency war because if they don't, their currency goes up too much. Their exporters can't sell anything to the rest of the world, and their economy implodes. And so it doesn't seem like there's any way out. We're going to try this experiment. We are going to create as much new currency as the guys in charge think is needed to offset the bad debt. But of course, the process of creating all that new currency leads to more bad debt being created, which is what we've seen in the last few years. It leads to malinvestment. And so that's really the thing that short circuits the process is that, yeah, people borrow money and they buy stuff, but a lot of what they buy, they shouldn't buy in the first place. And a lot of what they build with that new money, they shouldn't have built in the first place. And so you end up with Chinese ghost cities.
Yeah.
And, a lot of what we had in the U.S., where we had basically 10 million too many houses in 2008 versus what we really needed, and had to work that off for 5 years. So that's what we're headed for. And, how it plays out is really anybody's guess. There could be lots of ways for it to play out, but none of them are pleasant.
That's the Keynesians don't understand the concept of malinvestment. And the other thing I think they don't understand is that we are printing money. When we're printing money, I like to say that debt is the raw material from which money is manufactured in a fiat currency system. Now, a lot of the money is sitting in banks. It's not being lent out, I recognize, or it's being used in one way or another by the banks. But it seems to me that's the big difference. Now, if we wanted to go the route of hyperinflation Germany or Zimbabwe, John, well, if you could just print the money and not have the other side of the ledger, that is the debt side, you literally printed money and showered it out over Walmart parking lots and let people have, $100 bills, infinite numbers of them, then you most certainly would see massive hyperinflation, I guess. Do you see that as a possibility in any event, given the current structure?
Well, we'll try something like that eventually. A lot of what we do is already helicopter money, but with electronic money instead of physical money dropped out of helicopters. So we're already doing it to an extent. And the Paul Krugmans of the world, the Keynesians of the world would say that the problem is we're not doing enough of it.
Yes.
And they're going to win the argument because there is no other side to the argument that promises pain-free progress.
Right.
And so whatever happens, whoever gets elected next, it's going to be overwhelmingly tempting to ramp up the printing press again, just because that's a thing that gets you through the next couple of years usually. And the long-term consequences will be whatever they are, but you get through the next election if you print a lot of new currency.
Yeah.
Until right at the end when that stops working. But there's a good chance that the end is a few years off. So if you can buy yourself 2 years in which to be popular and in which to get your other initiatives taken care of if you're a politician and build your legacy, then of course you're going to try it. So whether you're a Republican or a Democrat in the U.S., it really doesn't matter. You're going to be an easy money guy. And so that's the corruption that comes from fiat currency. Once you hand a printing press to a government, you end up with a situation where there's so much debt that there's no pain-free solution in the long run, and the only pain-free solution in the short run is to print more money. And so that makes the long run problem even worse. But you can't do anything else if you don't want to be this generation's Herbert Hoover. And so that's the situation that faces these guys right now. If they tried to run a country that was living within its means, they would have an instant depression on their hands.
Oh, and it would be a depression that would make the 1930s look like child's play, I'm sure. But we're going to have one anyway, John. We're going to have a depression anyway, ultimately. It's just a question of, whether or not we do it voluntarily, the politicians do it voluntarily. And as you suggested, and I think you're absolutely right, there's no way they will. They're going to do it till we have what might be called a crack-up boom, I suppose, and a massive, massive amounts of money creation that just ends up, people just finally give up on the dollar, give up on currency, and say we got to trade this worthless fiat money in for something that is real. And that leads me to, I guess, the concluding remarks I'd like to get from you. Is while the politicians are conning everybody into believing that they still have the answers, what should we be doing then?
Well, we can't change the political process. This has institutional momentum going now where it doesn't matter if Jeb Bush is the next president or Hillary Clinton or name your person other than Ron Paul. And because it doesn't matter who gets elected, then politics ceases to be important for the average person, even though we all have our opinions and we care about certain issues. But we can't stop the country from going over the waterfall by voting. And so all we can do is take care of our own lives right now. And that means structure your finances so you're relatively safe if there's a huge currency crisis. If the dollars in your bank account are going to be made way less valuable by explicit government policy, then you don't want to have a lot of dollars in your bank account. And you want to own real assets. Sooner or later, gold and silver will be huge winners in this kind of a scenario.
Right. And
so will other forms of hard assets like farmland and really well-chosen rental properties like certain kinds of real estate. And so those are the things that you want to own to get yourself through this kind of a indeterminate but stressful process that's coming. And you want to pay off as much debt as possible, even though in theory inflation helps debtors. If you owe money, you got to be really sure that you can pay that off, because if you lose your job or your other investments go bad or any number of other things happen and that causes you to be unable to pay the interest on your loan, then you lose whatever asset that was that you borrowed and you lose everything. Yeah. So it's probably better for the average person to pay off debt. If you can go debt free, own some gold and silver, maybe own a rental house, something like that, then financially speaking, you'll come through this in pretty good shape.
Right. Yeah, well, I think that's good. Definitely good advice, certainly consistent with what listeners to my radio show and to various podcasts that I do hear from time to time, almost every week, I would say. But I don't think we can emphasize it enough. And, of course, people will go back and listen to the mainstream media and they'll be convinced, or they might not be convinced, but certainly hear the persuasion from the from the smooth talking Harvard PhDs that everything is fine. Just put your trust in the PhD standard, as James Grant calls it. But those of us who think a little more deeply, I think, don't necessarily agree with that. John, I want to thank you very much for spending your time with us. Thank you for your insights, and I hope we can do it again next week.
Thanks, Jay. I look forward to it.